Hello to you all awesome grade 12 mindsetters who are doing accounting buffins. My name is Abram and I'm ready to be your host today and taking you through to your favorite subject, which is accounting. By the way, it's also my favorite subject. I'm joined by Mr. Martin again. How are you, sir?
Hi, I'm fine, thanks, Abram. How are you doing?
I'm doing good, man. It's been a while, but yeah, I've been seeing you on the channel, on the revisions and everything. I see that everything's still well, huh?
Yeah, everything's good, thank you.
All right, what are we doing today?
Okay, so today we're doing a cash flow statement, which is going to be one of the important skills that you have to learn, one of the financial statements that you have to produce as a grade 12 learner, and I'm sure you've started it in class already, so today we're going to take you through an example.
Awesome. Talking about important things, you can download your notes all for free at learn.mindset.co.za. Follow us on Facebook at facebook.com/learnextra, and you can follow us on Twitter also at learnextra. Bring us all your comments. You enjoy the show, your questions also, we'll tackle them later on the show. But here's an interesting thing for you mindsetters. Today is the last day for the Test Yourself question giveaway by Vodacom, whereby we're giving away airtime vouchers worth 110 Rand. So you have that opportunity to take the Test Yourself questions once more and submit your answers on the link that is provided on Facebook, and you could win an awesome airtime voucher, probably sponsored by Vodacom. Another thing is that, Martin, we are doing a Walk Together campaign whereby we want the mindsetters to tag along because we want them to reach the end with good marks and be the better people they can be. So what needs to happen is, as a mindsetter, you can win an awesome pair of tummy takers like mine. You see how awesome they are? Look at this. Look at this.
Those are really great.
They're so awesome. Hey, look at this. They're so stylish. Yes?
I'm very, very impressed, Abram. Taking style
You like
to a
them,
new
hey?
level.
You like them? If you like them, I'm sure the mindsetters also like them. So what you need to do to win, unfortunately, Martin, you can't win a pair.
Oh, that's a pity.
That's a bad one. But otherwise, what you need to do, mindsetters, is to caption a photo that we've posted on Facebook. The caption with the most likes will win a pair of tummies. We're giving away 3 pairs. Tomorrow at 1 o'clock, we'll be posting the winner's name on Facebook. So it's more like you caption the picture, and then I get you to like my comment, and you also get other friends to like my comment. And if I get maybe 30 likes and somebody has 10, I get to win that pair. So it's simple as that.
Sounds really, really good.
Awesome. I believe we also have the challenge question for today. Take us through, Martin.
Yes, so the challenge question today, this is the challenge question that you as mindsetters have to answer during the show. And really we're dealing with note number 1 to the cash flow statement. So if you know your terminology, you'll know that note number 1 is the reconciliation note between the net profit before tax and the cash generated from operations. What we want to ask you is, in this note to the cash flow statement, what we do is we make an adjustment for depreciation. There's a special adjustment for depreciation in that note where what we do is we add our depreciation back to the net profit before tax. And that sounds a bit strange because normally we know that depreciation is an expense which we usually subtract to get our net profit. What I want to know from you mindsetters, and our challenge question for today, is why do we make this adjustment? Why, in other words, do we add the depreciation back in note 1 to the cash flow statement? So that's the question.
Thank you. Let's continue.
Okay, so get those answers in, mindsetters, and see what you can do. We're going to start off today with a summary on the different parts of the cash flow statement. Remember, your cash flow statement is an essential financial statement that deals with, as it says, the flows of cash flows. And remember, you can have flows of cash coming in and flows of cash coming out. In other words, you can have what we call inflows and you can have what we call outflows. Now, what's important to remember, if you look at the face of the cash flow statement, you will see that it is divided into 3 main sections. And I'm going to talk you through these 3 main sections right now. So our first one is the cash flows from operating activities. If we're dealing with operating activities, what we're interested in is anything that relates to the operations of the business, or you can refer to it as the day-to-day running of the business. You know that businesses do many things on a daily basis. They pay rent, they purchase stock, they sell stock, they take out loans, they repay loans. But the important thing is here that the cash flows from operating activities relate only to the day-to-day events that happen in the running of the business. So we're going to consider cash flows from selling stock and from purchasing various items of stock, from getting money from debtors, paying money to creditors, basically all our operations of the business, our working capital that keeps our business running. That is the first part of the cash flow statement. Our second part is also important, and those are cash flows from investing activities. When we speak about investing activities, we refer to specifically the purchase and the sale of non-current assets. Non-current assets. Remember, non-current assets, you can remember, are usually our land and buildings, our vehicles, and our equipment. You can remember those three, LVE, because you love accounting, if I put a little O in there. Basically, what you must remember is when we purchase or when we sell some land and buildings, when we purchase or sell vehicles, when we purchase or sell equipment, we are dealing with the investments of the business, our investing activities. So in this section, we are going to look at the sale and purchase of non-current assets. And remember, when we sell an asset, we're getting money for it. So that would be usually a cash inflow. I'm just going to put that with a positive sign. And the purchase, if we buy something and we pay cash for it, that would usually be a cash outflow. You have to part with your cash to gain a non-current asset. So remember, mindsetters, that's the second bit, the cash flows from investing activities. Our third section of the cash flow statement is what we call cash flows from financing activities. I'm sure many of you have heard of the term financing something. We would take out a loan to finance the purchase of a car. We would take out a loan to finance the purchase of a building. Those are what we call financing activities. It basically relates to the question of how does the business get its money? How does the business gain money? And what we are relating to here is the two main financing ways of gaining capital or other cash that we can use in the business. We're dealing with loans and we are dealing with shares. Because remember, if I want to start a business, I can either borrow the money from the bank, in which case it will be a loan. That's one way of financing my business. Or the other way would be to invite shareholders to purchase shares in my business, in which case I'd be issuing shares and financing my business through share capital. So whenever we're dealing with the issuing of shares, whenever we're dealing with the taking out of loans and repayment of loans, we are dealing with our financing activities of the business. And also, you will know that the syllabus includes now the buying back of shares from the company. When the company buys back shares from its shareholders, which you would have seen in previous shows about company ledger accounts, we're also dealing with the financing activities in the cash flow statement. So please be very, very sure that you understand those three parts. Those are your three sections of the cash flow statement, and they appear on the face of the cash flow statement. Just like your balance sheet is divided into one section of assets and one section of equity and liabilities, in exactly the same way, your cash flow statement is divided into these three parts. Remember them: operating, financing, and investing. Also, mindsetters, you will see that we have put some multiple choice questions up onto the website. Those multiple choice questions are designed to make you understand the difference between these three areas. So I've asked you, for example, what would, when the company takes out a loan, which of the three categories would it fall into? You would see that taking out of loans is a financing activity. So see if you can answer the questions that we've posted, the multiple choice ones. See if you can answer them to improve your understanding of these sections. Okay, now, today's focus is really going to be Note 1. Note 1 to the cash flow statement. That note has got a very long title, which I'll show you just now. It's the reconciliation note between your profit before tax and your cash generated from operations. So I've just put some steps in here to help you get the hang of completing this note. So the very first thing that you have to do is you start with your profit before tax. Okay? This I cannot overemphasize. It must be your profit before tax. So somewhere in the income statement, you need to find the profit before tax, and that is the first number that we're going to begin with. Please note that it's always your profit before tax. Never, ever, ever your profit after tax. And so what that means is that often the question is going to require you to work this profit before tax out. Okay, so I'll just give you a quick example. Let's say that the profit before tax is 100,000 Rand. What we now do to get the tax rate, and I'm sure that you've done this before in the activities on financial statements, somewhere in the question it will give you a tax rate. And let's say that the tax rate is 30%. So let's say that the tax rate is 30%. What you'd have to do is you'd have to work out 30% of your profit before tax, which is 30,000. You can check it on the calculator if you don't believe me. And what we then do is we subtract the tax from the profit before tax to get the profit after tax, which is 70,000. So, mindset is what you must be aware of when you are answering a question. The question is going to give you maybe the profit after tax and the tax, and you'd have to add it back to calculate the profit before tax. And there are many ways in which the question can be set out to make you calculate the profit before tax, but there will be enough information in the question to let you work out what the profit before tax is. So make sure that that's where you start with. The next two steps are our two adjustments. There's an adjustment for depreciation, and there is an adjustment for interest expense. What we have to do is we have to add back our depreciation, and we have to add back our interest expense. I asked you in the challenge question, why do we do this adjustment? We're going to answer it later on. See if you can figure out why we add back the depreciation. And we also have to add back the interest expense to this section. The reason we do that is because interest has got its own special place on the face of the cash flow statement. So if we put it all together, we don't want our interest to appear in two special places. We get rid of the effect of the interest expense by adding it back. When we do the example just now, you'll see what I mean. Okay, now we've done those two steps. That gives you a little answer which is called your operating profit before changes in working capital. So you take your net profit before tax, add back your depreciation, add back your interest expense, and that gives you an answer called operating profit before changes in working capital. Now the next step is the step that you must be very clear that you know what you're doing. We are going to calculate our changes in working capital. And the way we do that, there are three parts. Firstly, there is a change in inventory. And what we're going to do is we're going to calculate our change in inventory by comparing last year's inventory to this year's inventory. You just subtract the one from the other and determine whether there is an increase or a decrease. An increase in trading inventory or a decrease in trading inventory. Then we do the same for trade and other receivables. You look at your trade and other receivables and determine whether there was an increase or whether there was a decrease from last year. And then the third step is that you do the same thing for trade and other payables. What's important here, mindset, is to never forget is that the signs of this are very, very important. Okay, so I'm just going to quickly summarize them for you, and then when we do the exercise, you'll see what I mean. When inventory changes, it can increase or it can decrease. Now, what you must remember, if inventory increases, what that means is I've got more inventory now than I had at the beginning of the year. Okay, I've bought inventory, I started with some inventory, and now I've got more. So if my inventory has increased during the year, I must have paid somebody money for that inventory, which means there's going to be a cash outflow. So if I buy something, I spend money, I spend cash. To get more inventory, I would have had to pay some money out. So what that means is that when there's an increase in inventory, the sign is going to be negative because it is an outflow. In the same way, if I now have less inventory than I had at the beginning of the year, I must have sold it to a person. So if I've sold it to a person, that person must have given me some money. For me to get money from that person, it would be a cash inflow. So what you must remember is that when inventory decreases, the sign is positive because it represents an inflow of cash. Make sure you understand that, and we're going to apply it just now. In the same way, my change in trade and other receivables is exactly the same sign. If there's an increase in trade and other receivables, the sign is negative because if I owe people, if my debtors owe me more money now than they owed me at the beginning of the year, I must have lent them that money. If you at the beginning of the year owe me 50 Rand, and at the end of the year you owe me 100 Rand, what must have happened during the year? Somewhere and somehow I must have lent you 50 Rand. So I would have had an outflow. But in the same way, if it decreases, if you owe me less money than you did at the beginning of the year, you obviously would have paid me back that money. So that would be an inflow of cash. So a decrease of trade and other receivables is an inflow of cash, so it's positive. You need to think about this next one, which is trade and other payables. Trade and other payables has got the opposite sign. It increases, then it's positive, and it decreases if it's negative. I challenge you to think about why that is the case. I'll tell you later on. Then, finally, the very important thing is this, E. What you must please remember to do when you're calculating the increase or the decrease in trade and other receivables and trade and other payables, you know that there are many items. In trade and other receivables, for example, there is debtors control, accrued income, prepaid expenses, and there can be SARS income tax. Okay? What's very important, when you're doing the calculation, please, please, please don't forget to do this. Exclude interest, exclude dividends, and exclude SARS income tax when you're doing the calculation. The reason we do that is because those three items, interest, dividends, and tax, have got their own special place on the face of the cash flow statement. So if you see something which is a long note on trade and other receivables, which has SARS income tax, or you see a note with trade and other payables, which has dividends on ordinary shares, shareholders for dividends, and SARS income tax, basically anything that relates to interest, dividends, and tax, those three items have to be separated from the calculation. So those are the key things to remember when we're doing this note. I've kind of explained that to you now, and what we're going to do after the break is we're going to work through one of the examples. So I think it's time for a break now, Abra.
It is. Thank you, Martin. And Mindsetters, if you're watching, let me know on Facebook how's the show. If you're having some questions, we're here to help you through. So send them through. Otherwise, we'll see you after this break. Welcome back, awesome Mindsetters. Now, there's a quote that says, "No one has ever lacked by giving." Talking about giving, we have been nominated by Lou yesterday on the Life Science Show. What he did was nominating us for the RAP nominations to do something awesome, to give out to the community, to the Mindset community, and to everybody that keeps on supporting us as Mindset. So John, on behalf of Mindset, has accepted the nomination, and I'll be telling you more, keeping you updated on what's going to be happening. Keep your eyes peeled on LearnExtra, because we'll be telling you more what we are doing as Mindset. But however, if you have some suggestions on what we could be doing, send them through on facebook.com/LearnExtra.
Thank you, Abram, and welcome back, Mindsetters. What we're going to do now is going to look at one of the Improve Your Skills questions. And this is a real question from a past paper where what we're doing is we're going to prepare a full cash flow statement. But unfortunately, we only have an hour in the show, so what we're going to do is only do the first note, which is note 1, the reconciliation note. But you can prepare the other one in your own time. The answers have been posted up on the website, so you can see how to answer this question. So here's the question, which is telling us that we've been presented with the financial information for Posh Limited, that's the name of our company, for the year ended 30th of June 2013. And you can see here that there is a long extract of balances from the trial balance. So typically the question takes this format, where you get given a whole trial balance and you have to use the information in the trial balance to prepare the full cash flow statement with some of the notes as well. Okay, and today we're only going to prepare note 1 because of time constraints. And notice as well that this question is in a bit of a different format because look, it says 3,100,100. If you see a financial statement that's presented like this, don't get a fright. It's not a comma like in mathematics where it means a decimal point. They just to separate big numbers and make them easier to read. Sometimes some financial statements will have a comma like this to separate the numbers. So this 3,100,000 is simply 3.1 million rand. Okay, so 3,100,000. So just make sure that you are aware of that. That's the way that sometimes the question is done. What we need to do now is we need to look at the various pieces of information that we have. Okay, we've got a whole long information, ordinary share capital, retained income, various things. It's a full trial balance, or at least an extract from it with most of the accounts. And we also have an income statement for the year. Remember before the break what I said. The first thing that you need to do when preparing the note, which by the way looks like this, here's the note. It says reconciliation between profit before taxation and cash generated from operations. The very first thing that you need to do when starting this note is to find your profit before tax. Remember I said that before the break. So we now have to look at the information that we've been given, and we have to find somewhere our profit before tax. So if you look at all this information here, this is from the balance sheet, or from the post-adjustment trial balance. But most of these items here are actually from the balance sheet. And we know that if we want a net profit number, we need to look at the income statement. So number 2 is the extract from the income statement. What they've done here is they've given us a whole lot of items: interest on loan, depreciation on vehicles, depreciation on equipment, profit after tax, and profit before tax. But unfortunately, there is a question mark here. Question mark on profit before tax. So what that means is that we're going to have to calculate what the profit before tax was. The only piece of information that we've been given here is the profit after tax, which we know is 575,280. So that's the first piece of information that we have. We're not given the taxation anywhere. If you look back further up, you are given these two numbers of SARS income tax. Those two SARS income tax amounts are the balances in the SARS income tax account in the general ledger. They, remember, do not relate to my real income tax for the year. They are just our provisional tax payments, because remember, go back and revise the difference between SARS income tax and income tax. So what we're actually looking for is income tax, but it's not given to us, so we have to read a little bit further. And if you go down all the way to point 8, there we finally see it. Income tax is calculated at 28% of net profit. So we know that we're going to take our net profit, work out 28% of it and subtract it, and the answer is going to be our profit after tax. But now what we have to do is work backwards. So let me show you the trick and how you should do it. What I normally tell my learners is to write here profit before tax. Then we put taxation, and then we put profit after tax. And what you should learn to do, and this is a skill that's going to become useful in many, many different questions, you should write down the percentages that each of these represents. So what you need to remember is that profit before tax is always 100. I'm just going to write the 100 here. You'll see why in a moment. So profit before tax is 100. To work out the taxation, I'm going to work out 28% of that number. So that is 28%. Okay? And then that means that my profit after tax, if I take the 100 and subtract the 28, because remember you always subtract your taxation from profit before tax to get profit after tax, I end up with 72. So these are the three percentages. The profit before tax is 100%. We then subtract 28%, which is our taxation, and we're left with our profit after tax, which is 72%. You may have seen this method before in grade 10 when you calculated sales and cost of sales and markups. But I'm now going to take this method and apply it to the profit before tax. What I'm going to do is insert the number that I have here, and if we look back at the information given in the question, the amount that we were given was the profit after tax of 575,280 Rand. This number here. So we're given our profit after tax. So I'm going to write it in my little table here. 575,280, just checking that it's right. 575,280. The number that I want is this X at the top here, which is the 100. Okay, so I want to know what my profit before tax is. But I've only been given my profit after tax. Now, here is the method that you should use. If you want to calculate an unknown but you know the different percentages and how they relate to each other, what you do is you multiply by the percentage that you want, and you divide by the percentage that you have. So right now, the number that I have is 575,280. So let me write it here, 575,280. That's the number that I have. And that number represents 72%. So I have 72% of the number that I'm trying to find. So I have 72. What number am I trying to find? What number do I want? Well, I want this x here, which is 100%. So I'm going to have to multiply by 100 at the top. So what this now means is that if I want to calculate my profit before tax, I'm going to take my 575,280, which I have, and I'm going to multiply it by the percentage that I want, which is 100, and divide it by the percentage that I have, which is 72. That is going to give me my profit before tax. Mindsetters, you can also use this method if you want to calculate the tax. So suppose I want to calculate the tax instead of the profit before tax, and I'm given the same number and the same relationship between them. If instead I were to multiply by 28 over 72, that would give me my tax number. Okay, so in this example, I don't want the tax, I want the profit before tax, so I'm multiplying by 100 and dividing by 72. That will give me this number at the top, the profit before tax. In the same way, though, if I wanted my tax instead, I would multiply by 28 over 72 to give me that answer. So this is a very, very useful method. It will also come in very useful when later on you learn about VAT calculations, calculating that. It's also often used when you're calculating discounts and debtors paying and so on. So you as mindsetters need to master this method because you're going to find it very, very useful to work out percentages if you get given one number and have to work backwards. So if we now want to work out our profit before tax, let's get the calculator up. What we're going to do is just type in this little calculation onto the calculator, and it's going to be 57. I've got some calculator gremlin here at the moment. Let's try that again. 57. I'm just trying to turn off the ink layer here. Turn off the ink layer. Okay, so let's try the calculation again. It's going to be 575. Okay, let's try it again. So it's going to be 575,280. And what we're going to do is multiply it by 100 and divide by 72. This, by the way, mindsetters, is why you should, if you can, invest in a spare calculator in case one breaks when you're writing a test or doing an accounting activity. What we get is our net profit for the year is actually going to be 799,000, 799,000. Multiply by 100 and divide by 72 because you're multiplying by the number that you want and you're dividing by the percentage that you have. So if I go to the answer sheet, I'm just going to fill it in. I finally got my net profit before tax, 799. Just check what that number was again, 799 and 3 zeros. Okay, so it was quite a bit of work to get our first number that we needed, but it's worth it because we have to make sure that we get the correct net profit before tax, and usually that would be worth about 3 or 4 marks because you need to do the calculation. Now let's go to our second step. Our second step is that we have to adjust for depreciation and interest expense. And if we go back to our information, let's look up there, it gets given to us here. Depreciation is given in the income statement, and notice, mindsetters, that there are 2 of them. There's depreciation on vehicles and there is depreciation on equipment. So if we want that number, we're just going to add the 2 together. That's going to be 411,411,000 plus the 361,361,000. Remember, you want to add back your total depreciation for the year, which is going to be 772,000. So let me put it in. If I go back to the answer sheet, 772,000 was my answer for depreciation, 772,000. And we also have to add back our interest expense. Sometimes you have to do that calculation by a timeline with a loan. I'm sure you all remember how to do that. You take a loan and draw up a timeline and work out the interest for the year. But often that's also given to you. And in our question, it was given to us here as interest on loan. The number we're looking for is 468,000. So what we have to do is add that back as well. So 468,000 we write in here as the interest on the loan. Those two things are our two adjustments, and what we must do is add them up to get our operating profit before changes in working capital. So there's my 772,000. It's already in the calculator. I'm going to add the net profit before tax, which was 799,000, and I'm going to add the adjustment for interest, which is 468,000, and that gives me 203,900. 203,900. Let's write it in here. That number is called my operating profit before changes in working capital. Now, mindsetters, this part is quite important. We now have to see what are our changes in working capital. And what we have to do is look first at inventory, then at debtors, and then at creditors. So let's go back to the information that's been given to us. Notice that this question is giving me comparative figures for 2012 and 2013. That is last year 2012, this year 2013 in the question. So to work out what we've done with our inventories, we have to look at this line here, inventories. What have our inventories done this year? Let me also give you some advice. Use a ruler in an exam to be able to see the numbers quickly. So at the beginning of the year, our inventories were 546,000. At the end of the year, our inventories were 513,000. They've changed from 546 to 513. Have they increased or have they decreased? Well, if something moves from 546 to 513, it's gone down. It has decreased. So what we need to do is on the line here, we have to write the word decrease in inventory. How do we know it's a decrease? Well, we know from our information that it's gone down from 546,000 to 513,000. Now we must do the calculation. So to do the calculation, we just open it in brackets and write it in here. It was last year's number, which was 546,000, and it's now decreased to, let's check it again, it's decreased to 513,000. So let's fill those numbers in. 546,000 minus 513,000, and let's do the calculation and check to see what we get. It's going to be 546,000 minus 513,000, and the answer that we get is 33,000 Rand, and that is the number that we are going to write here, 33,000 Rand. But now, we're not done yet. What's very important now is to realize whether the sign is going to be positive or whether the sign is going to be negative. What we said earlier before the break was that if there's a decrease in inventory, it means we're selling inventory, so we are getting cash. Cash is coming in. So if there's a decrease in inventory, what that means is that this sign must be positive because it represents a cash inflow. We're going to do the same now with our debtors. So what we're going to do is check back over here and see if we can find our debtors. Here we've been given our net trade debtors. This is the second number that we're going to look at. And the number has changed from 1524 last year to 1988 this year. The number has actually got bigger, in other words, an increase from 1524 to 1988. So once again, on the answer sheet, we're going to write the word in here. It's going to be an increase. It's an increase in debtors. We're going to calculate the change in debtors by looking at the numbers 1988, 1524. Let's just compare them. 1988 with 3 zeros minus 19, sorry, let me check the number again. 1524, sorry, with 3 zeros. So 1524, 000. Let's do the calculation and fill the answer in. So it will be 1988,000 minus 1524,000. The answer comes to 464,000. Let's write that answer in here, 464,000. And now, again, we've got to get the sign right. But in this case, it was an increase in debtors. In other words, there are more people owing us money now than there were at the beginning of the year. For that to have happened, we must have lent them the money. In other words, we must have given money out of our business to lend them that money because they're going to pay us back. So what that means is that our sign here must be negative, because if our debtors have increased, we have got a cash outflow. Okay, the last thing we have to do here is look at the creditors. So our creditors are given to us here as trade creditors. Let me maybe just change the color. Trade creditors, this yellow. These trade creditors have also changed. They've changed from 1183 to 1315. 1183 to 1315 is actually going to be an increase because the number's gotten bigger. So I'm going to write over here that it is an increase in creditors. And once again, we have to do the calculation. To do the calculation, it's going to be 1315,000 minus 1183,000. Let's write in brackets 1315,000 minus 1183,000. And if we do it on the calculator, we get the answer 1315,000 minus 1183,000. The difference between these two is 132,000. So I'm going to write 132,000 in here. Now again, we have to check what has happened to the sign. If we've got an increase in creditors, what that means is that we owe more people money now than we did at the beginning of the year, or we just owe more money than we owed at the beginning of the year. So if I owe you more money at the end of the year than I did at the beginning of the year, what must have happened is that I must have borrowed money from you. I must have gotten that money that I owe you. So what you must remember with this one, this is why I've done it in a different color, this is the only one where the increase is positive and the decrease is negative. So this one we're going to leave as it is as 132,000. So that's basically the completion of note 1. You would just now have to add these three numbers together to calculate the changes in working capital, and then this plus this, in other words, your operating profit before changes in capital plus the changes in working capital is going to give your final answer, which will appear here, and that answer is going to appear on the face of the cash flow statement as your cash generated from operations. I think it's about time for another break, Abram.
Yes, it is, Martin. Let me remind you, Mindsetters, that you have only this day to win yourself an airtime voucher proudly sponsored by Vodacom. So make sure that you download the notes all for free and then do the test yourself questions, submit them to us, and stand the chance of winning an awesome airtime voucher. We'll see you after this break. Welcome back, Mindsetters. Now to tell you, earlier on I told you about the Vodacom competition giveaway that we're having. Now I must announce yesterday's winner, and her name is Andronika Sikwari. Congratulations to Andronika Sikwari. You've won yourself an airtime voucher worth 110, proudly sponsored by Vodacom. I wonder, how do you feel about that? Getting 110 airtime. Who would you call, Martin?
Oh, I'd love 110 rands worth of airtime. I think I'd spend it all in about an hour. Yeah.
Calling all your friends and
all
everyone.
Friends and family, yeah.
That's awesome. So Mindsetters, you still have a chance up until 10 p.m. tonight to get your answers coming on the form that is posted on Facebook. Otherwise, keep your questions coming, because now we'll be doing the challenge question. After the challenge question, we'll be taking your questions. Thank you, Martin.
Okay, thanks very much, Abram. Basically, if you'll remember, before the break, I asked you, in note 1 to the cash flow statement, we make an adjustment for depreciation. This adjustment is added to net profit. So just to refresh your memory, if you look at my answer sheet here, this adjustment here for depreciation, what we are doing is we are adding this number to get our operating profit before changes in working capital. The question I asked you was, why do we do this? For what reason do we add it when normally we know that depreciation is an expense and it usually gets subtracted? What you need to know is this. If I am calculating my net profit for the year, think back to your format of the income statement. What basically happens is you start off with sales minus cost of sales, and that gives you your gross profit. What you then do is you add your operating income, and you subtract your operating expenses. Okay, so think about how you get from gross profit to net profit. You get your gross profit, add your operating income, subtract your operating expenses, and then you do various other things with interest expense and interest income to get to net profit. But what you're actually doing is when you subtract your operating expenses, one of them is depreciation. So I'm sure you all remember this even from grade 10, when you first started the income statement, under operating expenses, there is depreciation. So we've subtracted depreciation somewhere along the line to get to our net profit. But the problem is that this particular statement that we're doing is a cash flow statement. A cash flow statement, in other words, we are only dealing with cash. We are not dealing with any expenses that are non-cash items. Depreciation was a non-cash item. I'm sure you remember from grade 10 and grade 11 that people referred to depreciation as an imputed expense or as a non-cash item, because if something is depreciating, you're not actually losing any cash. You don't have to pay any cash from your bank account to cover the depreciation expense. Think about one of your assets that you might have. Maybe you've got a computer, maybe you've got a cell phone. That cell phone is getting older every day, it's depreciating, but you're not actually taking any cash out of your pocket and paying for that depreciation. So depreciation being a non-cash item, we want to get rid of it because we're only concerned with cash flow statements. You should know as well that depreciation is not included in any cash budget. So whenever we're dealing with cash, we must eliminate the effect of depreciation. To eliminate that effect, what we do is we add back depreciation on the face of the cash flow statement. So if I relate it to this answer sheet, this profit before tax of 799,000 happened after I subtracted depreciation. But I'm only interested in my profit before tax in cash flow statements, that is cash items. So what I'm actually doing is I'm adding back my depreciation to consider my profit that I've made from my cash flow. Okay, so I don't know if, Abraham, if anybody answered that correctly on the page, but the answer that I was looking for is basically just depreciation is a non-cash item, and we add it back to eliminate its effects. So that is why we add our depreciation back to eliminate the effects, because we subtracted it to get to our net profit. Okay, so that completes the answer to the challenge question. I don't know if there are any questions on Facebook or on Twitter that I must answer.
Yes, there are, but congratulations to everybody that got the challenge question correct. Thank you, Mindsetters. Nkule Zungu says, if you're given a profit and loss, how to find net profit after tax?
If you're given the profit and loss, so in other words, if you're given, I'm not quite sure whether he means a profit and loss account like this, a profit and loss T account, or whether he means that profit and loss is given to you in the appropriation account. Let me just answer that question like this. If you think back to your year-end adjustments that you did in grade 10, you know that all your incomes and expenses are closed off at the end of the financial year to first your trading account and then your profit and loss account. So this is just some revision of grade 10 work. You would have the balance on your trading account transferred to profit and loss, and then you would list all of your other incomes like current income, fee income, rent income, and so on. You'd list on this side, and on the debit side, you would list all of your expenses like water and electricity, salaries, etc. What now happens is all of the expenses that go in the profit and loss account will be closed off, and we will then calculate the balance on the profit and loss account, which, if it is a profit, will appear over here. In other words, all of your incomes are more than all of your expenses, so your balance brought down would appear over here. When we do accounting for companies, this number is transferred to your appropriation account. So whatever the difference between the incomes and the expenses are gets transferred to your appropriation account. I'll just extend the page a bit. So in my appropriation account, you would know that it's got a specific format, and I put my profit and loss on this side over here, profit and loss. I'm sure you've seen that when you did your company your company ledger accounts. So this number here, this profit and loss number, is actually already the number that we're looking for. The number that appears in your appropriation account on the credit side is always your profit before tax. How do we know it's our profit before tax? Well, think back to the format of your appropriation account. On this side, you have income tax. Remember, this is your assessed tax for the year. So you're going to take your profit and subtract your income tax, and then you're going to subtract your ordinary share dividends, and the balance is going to be your retained income. So to answer the question, if you are given the T account with appropriation, the number that appears next to profit and loss is the number that we're looking for to start our note 1, because this is our profit before tax. So I hope that's answered the question.
Thank you. I hope Nkulu you answered. Let us know. Otherwise, another question is from Lucinda Buhle. If the cash flow statement deals with the inflow and outflow of cash, then why depreciation?
Why depreciation?
Yes.
Well, that's actually the question that I asked as well. What do we do with depreciation? We subtracted it in the income statement to get our profit before tax. So what we would have done to calculate the number for profit before tax, we would have subtracted depreciation. So this number is after depreciation has been subtracted. Now, because it is a cash flow statement, we don't want to include depreciation. So we make an adjustment for depreciation to add it back to the cash flow statement so that we're only dealing with our cash items. You see, if I first subtracted 772,000, which is my depreciation for the year, somewhere in the income statement of this question, I would have subtracted 722,000 to get this answer of 799. So because I didn't want to subtract the 772,000, I'm not interested in depreciation. I don't want to consider its effects at all. I have to cancel it out by adding it back over here. So the 772,000 was subtracted in my income statement to get my net profit before tax. But if I want to eliminate its effects, I'm adding it back to get rid of it. You know, if you've got a negative number and you want to make it back to 0, you add that number back to cancel it out and to get rid of its effects. So the reason we include the depreciation here is to eliminate its effects and concentrate only on our cash because it's a non-cash item. Okay, any other questions there?
Awesome. I hope, Lucinda, you answered. Kahisho Onis Pijati. What is depreciation and how to calculate depreciation on vehicle?
Okay, to calculate depreciation on vehicles is actually a different section of the syllabus, which I wasn't going to cover today. So what you need to do, usually in a cash flow statement, what they would have is they would give you the depreciation somewhere, like they did here. But let's say that in this example, they asked you to calculate depreciation on vehicles. Let's say they asked you to calculate it. Somewhere in the question, what they must do is give you a depreciation rate. So let's say they give you that the rate is 10%, and then they must give you a depreciation method. And the method can either be on cost, which is the fixed installment method, or it can be on the diminishing balance method. So let's say that in this question they didn't give us our depreciation, but we wanted to calculate our depreciation on vehicles. What we're going to do is look at these two balances here. So this balance at the top of 2.45 million is the cost price of my vehicles. If I wanted to calculate my depreciation, and it was on the cost method, my calculation is just going to be 10% of 245 million. Okay, that's if it's on the cost method. So you're going to type that into the calculator, work out 10%, in other words, 10 over 100 times 2.45 million. That's the cost method. If, on the other hand, it was on the diminishing balance method, what you need to do is you must remember to first subtract the accumulated depreciation. So your calculation is going to now be 10% of, you're going to take the 2,450,000, which is my cost price. Sorry, there's 1 0 missing. But I'm first going to subtract the accumulated depreciation of 836,000, which I'll put here. So it's almost the same calculation. If it's on cost price, you just work out 10% of your cost price. If it's on diminishing balance method, you work out 10% of the difference between these two. The 245 with the many zeros minus the 836,000. But that's a section on its own in asset disposal and in fixed assets, part of the grade 11 syllabus, because there are sometimes complications. So just make sure that you revise that before your final exam, because many questions are going to ask you to calculate depreciation.
All right, thank you so much. Just say goodbye to our learners, because our time is against us.
Right, thanks everybody for tuning in. Mindsetters, all success for your exams, and we'll see you soon.
Thank you so much, Martin. And to everybody that is writing tomorrow, we wish you nothing else but the best. We're crossing fingers for you. Keep learning and practicing, because you are going to master it. But from us, Abram and Martin, for today, we just want to say peace.